Well, everyone, I know everyone here is business people, and you all have to get back and get a job done and be prosperous this afternoon, so we're going to go ahead and get started here. Go ahead and finish eating. Take your time. No worries on our part. I'd like to start today to tell you a little bit about the people that put together the Economic Forum, and that's the Rotary Club of Jasper. We're comprised of 33 members, and I did the math one day. I think we've got like 85% of our members are active in one or more groups. So we have a very active group, and we're all looking for ways to make Du Bois County a better place to live, work, and play. In addition to today's Economic Forum, you might know us for the Athena Awards banquet, where we honor women of Du Bois County. The Clay Shoot, which OFS, thank you OFS, has been so kind to let us use their facility. And we also have a high school unit called the Interact Club. So we are branching out into new ways. Rotary International is part of who we are, and Rotary International is working to eliminate polio from the face of the earth and provide clean drinking water to places that do not have it, things that we take for granted, and doing literacy projects. So a lot of things that you'll see the local club doing reinforces what Rotary International is all about. You might have seen things that we've done with TriCap to put in a musical playground to help the literacy. We installed some handicap accessible equipment on the Riverwalk. And this year we have gotten up to 80 vouchers, about $10,000 that we have given to help children get safety training and learn how to get safety equipment to ride an ATV. So we're very excited about what we're doing in the community. I would like all the Rotarians to please stand. Who's in the crowd? So the Rotary Club meets every Thursday at 11:45 at Vincennes University, Jasper. If you would like to be part of this exciting group, just see one of us with a little name tag on. We'll be happy to tell you a little bit about who we are and how to get there. So Rotarians, thank you so much for all you do. Now, I do have one little thing I need to accomplish here. And Daryl, yeah, hi Daryl. Daryl, would you stand up for me? So Daryl has been one of the people that has made Rotary very fun for me. He is very passionate about Rotary. He's been in Rotary for 31 years, starting in Huntington. Is that correct? In Huntington. He works for Springs Valley Bank and Trust and is going to be retiring very soon, very, very soon, and moving down to Nashville to be closer to his family, and we're really happy for him. The Economic Forum has always been one of his babies, and he has done it with such great pride and such great pleasure. I just want you to know that I'm going to miss you, Daryl, and I thank you for all the years you've given to Rotary and to this project. So, who's taking over for Daryl? That's the big question, right? Well, he left it in capable hands. We have Derek Budd from Eagle Crest Financial and Nick Stevens from Old National Bank, who are leading it this year. And at this time, I'm going to turn things over to Derek, who is going to start our panelists and get the program running for you all.
Hello and welcome. Thank you all for coming. Before we get started with the panelists and all their conversation, just want to take a minute to honor all the sponsors today of this event. First with the bowl sponsors, we've got Springs Valley Bank and Trust, Old National Bank, Ken Sendowek with Merrill Lynch, Kimball Electronics, Hoosier Hills Credit Union, German American Bank, and Eagle Crest Financial. As bear sponsors, we've got Freedom Bank, WBDC, WJTS, Kimball International, WITZ, WQKZ, and OFS. And then lastly, with the neutral sponsors, we've got Du Bois County Herald, Du Bois Strong, Memorial Hospital, and Nante and Company LLC CPAs. If everyone could please just give a round of applause for all the event truly couldn't happen without all of your support and your continued support throughout the years. So we really do appreciate it, and thank you for your sponsorship of this event. One other note I'd like to say before introducing the panelists is that, so Daryl Blocker, who we just honored, he is going to be in the back by that registration table as you leave for any CPAs that were wanting to get CPE for the attendance today. So we'll dismiss him a little early later on, but just wanted to give you all a heads up that Daryl will help you with those papers that need signed at the end of the meeting. And so without further ado, I'd like to invite Bill Whitty up, but at the same time also introduce the other two speakers along with him. So to start with Bill, Bill is an associate professor emeritus of economics at IU in Bloomington. He retired from teaching from the Department of Economics at Indiana University in 2008. Bill has a PhD degree in economics from the University of Wisconsin. Prior to graduate school, he served as a line officer in the U.S. Navy. He joined the faculty at IU in 1980, following 5 years at Penn State. After Bill, we've got Charles Trzynka. And that's a tough name to say, and it's probably even harder to spell, but we appreciate him coming back multiple times. And so Charles is the James W. and Virginia E. Kozad Chair in Finance. One tidbit about Charles is that he actually taught a finance class that I attended at IU 6 to 8 years ago when we were talking about that at the table before, in behavioral economics or finance. And so Charles is going to talk about the financial markets, and I look forward to that piece as well. And then finally, at the end of the table, we've got Ryan Brewer. Ryan Brewer is an associate professor of finance at Indiana University in Columbus. He teaches undergraduate and graduate courses in corporate finance, investments, and derivatives, and has been there since 2009. Brewer earned the IUPUC Campus Center Outstanding Full-Time Faculty Research Scholarship and Creative Activity Award in May of 2018. He's also earned a number of other awards, as well as working for a Fortune 100 or 50 corporation in Michigan before joining IU. So I'd like to now invite Bill up to start his presentation, and then he'll pass along to the other panelists. Thank you again for all coming.
Thanks, Derek. Good morning, everyone. I'd like to start today, I'm here to talk about the national economy. I'd like to start today with a brief look backwards. Last year I was here, and at that time we were flying from an economic forecasting point of view pretty much blind. That was because, as you may remember, the Congress and the President mutually decided that it would be a good idea to shut down the federal government for a while. Typical Washington logic there. The result was that the data on the economy in the fourth quarter hadn't been released on schedule, and so we didn't have that. Based on what information was available, I presented a forecast for last year that was a little bit more pessimistic than the forecast that we presented when we did the Outlook panels in the previous November. But it wasn't quite pessimistic enough. Last year here, I said that the economy would grow about 2.7%, real GDP, the total output of the economy adjusted for inflation, during 2020. The actual number, during 2019, the actual number, which we now have since the data came out on time this year, was 2.3%, so a little bit worse than what we said. I said that employment would grow at a monthly rate of about 208,000 jobs. That was, again, too optimistic. The actual number for 2019 was 175,000, although it rose toward the end of the year. For unemployment, I said that we would have unemployment of about 3.7% at the end of the year. We were actually, it was lower than that. In December, it was 3.5%. Finally, inflation, I said about 2%. If you look at the inflation numbers that come out of the national income and product accounts, that's where the GDP numbers come from, the number comes out at about 1.6%, so lower than what I forecast. If you look at the consumer price index, it was right about 2%. Overall, that's not a bad forecast. A little bit too optimistic about output and employment, unemployment a little lower than we thought, inflation pretty much what we thought. So a fairly good forecast in terms of accuracy. And from an economic point of view, not a bad year. You know, we're moving into the 11th year of an economic expansion, or we're into the 11th year. That's a long time for the economy to expand, and it's still growing at a pretty good rate. And certainly if you look at us compared with, say, Europe or Japan, it's really good. Now the main reason that the economy didn't come quite up to my expectations was that business investment was really disappointing. For the year as a whole, business investment, that's business purchases of plant and equipment and software, intellectual property, I'm not even sure what that means, and structures, was about flat, basically no growth, as opposed to we expected that it might grow 5%. The year before, 2018, we got growth of 7% there. So zero is really disappointing. That was offset to some extent by good government spending, which I think that's coming from the budget deal that was reached in 2018, and I think that's about run its course. From improvement in the trade balance. Okay, now the trade balance improved because imports dropped a lot due to the trade war. So that's good for the economic numbers, but it's not really a good sign for the economy, I don't think. So we've got an economy that's doing pretty well. Investment's a worry. What about this year? Well, this year the forecasting problem is in some ways the reverse of what we had last year. Last year we didn't have any information to work with. This year we've got all sorts of information on all sorts of things about what's going on. The problem is that for a lot of that information, I don't know what it means, okay? To begin with, we do have economic data, and I think I do understand something about that. So what does that say? Well, the fourth quarter growth was 2.1%, same as the years, pretty much the same as the year as a whole. That's okay, but there were some odd things in the fourth quarter. There was a large drop in inventories and very weak imports, and those two were probably related. And there was strong government spending, things that characterized the year as a whole, but particularly the fourth quarter. For my forecast, I'm assuming that those things will sort of revert. So inventories won't continue really low. That adds a little bit of push to the economy as inventories are rebuilt. Imports will rise. In terms of overall economic growth, that's a negative, but rising imports rise because the economy is doing well and people are buying stuff. So it's not that bad. And I think the government spending is not going to measure up to what it was. So with that basis, what do we have? Well, start with output again, real GDP. I think that output growth this year is going to be about 2.1%. That's pretty close to last year, just a tick above the fourth quarter. Employment. Employment the last 3 months that we have data for, which is through January, has averaged 211,000 per month. I think we're not going to come close to that. I think that we're going to be closer to 150,000 for this year as a whole, with better numbers at the beginning and then declining. And the reason there is that we're basically running out of people to put to work. We are at a full employment economy. Unemployment. Unemployment in January was 3.6%. It went up from 3.5 in December. And I think that it's going to be about that at the end of the year, although I think we probably will dip down a little in between. And I think it's possible that we could get, the lowest we've had is 3.5%, and that's the lowest since 1969. And remember, in 1969, I can, from firsthand experience, tell you, we were in the middle of a war. And it wasn't just a little war like the ones we have now in terms of the number of people involved. It was a big war. There were 500,000 of us in Vietnam. Okay? We don't have that now, and we're still at 3.5%. We have been. I think we could get to 3.4 or 3.3, maybe for a month or two. With regard to the employment, another thing is that there's going to be enormous volatility in the monthly numbers because the Census Bureau right now is out there trying to hire 500,000 people. And those will be hired for a couple months, maybe, and then they'll be laid off. So you're going to have some months where you're going to have big increases in the employment numbers, maybe 400,000. And then you're going to have some months where you're going to have really low numbers and probably, not certainly, but probably a negative number somewhere in the middle, late summer, which would be the first negative number since the recession a decade ago. So that's a pretty good labor market. And then inflation, I think inflation is going to remain about where it is. Move up a little bit if you're using the GDP numbers, which is what the Fed looks at. It's 1.6% now. I think it'll get up to 1.8, 2%, something like that. That's not a bad year. Pretty similar to this year, except for the slowing job growth, which I think is inevitable. Okay, but what about all that I don't know stuff? I don't know what's going on stuff. Well, that could be a really long list. I could sit here for probably an hour and a half and talk about things like that. But I'm going to limit myself with great effort to just 3 items. And I think these are probably in reverse order of economic importance, although actually I hope not. So the first one on the list, the 2020 election. How many watched the debate last night? Well, you're braver than I am. I watched the basketball game. And actually, that was a lot of fun last night. I don't know. This is the most perplexing team that we've had in years. So why the 2020 election is actually probably potentially going to have a really big economic impact, but it's a 2021 or 22 story, really. The impact this year will be not too big. The uncertainty here is obvious. Who's going to be the Democratic candidate? I guess there were 6 of them last night. They all think they're going to be. Will he or she defeat President Trump? Who will control the Congress? What will happen to control of the Congress? Okay, those are all questions that I think are completely up in the air, and I don't have a clue what's going to happen with regard to any of them. Depending on what the answers to those questions are, the impact on the economy, again, mostly a year out, could range from positive through not much to seriously bad. Okay? The bigger problem is I don't know which answers go with which outcomes. Okay? And I can think of scenarios where any answer to any of the questions produces any of the outcomes. So that's something to keep your eyes on, but how it's going to affect the economy, I don't have a clue. Okay, number 2 on my list. Boeing to Houston, we have a problem. The 737 MAX thing, okay? Boeing clearly keeps producing, we got this under control, and then something else happens. They have now shut down production, okay, as of the beginning of the year. And there are several questions that you have to answer if you think about the economic impact of that. The first one is, how long does it last? Okay. Boeing seems to think till sometime in the spring. Second one is, as long as it lasts, what kind of an impact does it have on the economy? Now, I've seen some estimates of that. I saw an estimate that there's a thing, you can find it if you go to the New York Federal Reserve website. You can probably find it. It's a blog piece, sort of. And they did some back of the envelope type of calculations and came up with a number of 0.4% off GDP in each quarter that the shutdown lasts. Okay. Now, I looked at the way they did their calculations, and I think that a lot of them are kind of iffy. And probably that's a worst-case estimate. It's probably going to be something less than that. But even if the actual number is half that, and if the shutdown lasts for 2 quarters, you're still talking about, for the year as a whole, a tenth of 1% off GDP. Now, that might sound small, but remember, we're only growing 2%. So that's a 5% hit to GDP growth. So that's something to keep in mind. I think that there's a little of that in my forecast. The forecast has business investment relatively weak in the first part of the year and then getting a little better. So that can be interpreted as the Boeing effect. And then the third thing on my list. And this one is really the 6,000-pound panda bear in the room. Now, I don't see any masks here, but I do see them in Bloomington on occasion. I was eating lunch in a sandwich shop yesterday, and a woman walked in wearing a mask. The Chinese have clearly been behind the curve on this, and I think they still are. Consequently, we don't really know where we are. A couple of weeks ago, I sat in on a Skype call with a guy at NYU who's in some hospital in New York, who's a doctor, and he's in infectious diseases, and he really knew what he was talking about when it comes to this kind of thing. And he said that we just don't have the data we need. Now, that we've got more data now in the last 2 weeks, but I still think it's suspicious. And that means we can't really figure out what the impact's going to be. There are 2 things that you have to know. You have to know how infectious is the disease. In other words, how many people, how fast is it, how easily does it spread? Looks like this one spreads pretty easily, you know? And the second thing is, once somebody gets it, how likely is it that they're going to be seriously sick? And the number there seems to be, in terms of the data we do have, 2% of the people that get the thing. That's a pretty high rate, 2% death rate. The regular flu is 1/10 of 1%. 2% is comparable to the Spanish flu right after World War I, and that killed hundreds of millions of people worldwide. Now, I'm not saying that that's what we're in for, but we don't know. And then, even if we did know that, we wouldn't really have any way of getting a very good handle on how much economic impact it's going to have. Particularly, it's going to have an impact in China. But the Chinese data to begin with are bad, and that what they're going to release in terms of data about the economic effects will be bad. And then once we know, even if we knew that, what does that imply for the rest of the world? Well, that depends partly on how much the disease spreads outside of China, which so far seems to be relatively minimal. But still, if the Chinese economy, or a big chunk of it, is shut down for 2 or 3 months, that has big effects on everybody in terms of supply chains, if nothing else. So this is a big wild card out there that we just really can't make predictions, economic predictions about. It's something we'll just have to see how it unfolds. So, where does that leave the forecast that I gave a few minutes ago? Well, the forecast is basically an extrapolation of where the economy is now and where it would go under normal conditions, with a little adjustment maybe for the Boeing thing. Nothing to do with the election, nothing to do with the virus. So it provides a baseline about what you should expect, extrapolating away from those things. It gives you a basis for comparing, as things actually unfold, how the economy has been affected. But that's the best I can do. It's going to be an interesting year. I like Star Trek. I like science fiction in general. The Star Trek movies, at the end of the new series of movies, at the end of the first movie, as they're getting ready to sail off in the Enterprise, Kirk slaps Dr. McCoy on the back, and he says, "Buckle up." That's good advice for the economy for this year. Returning to Earth and to the 21st century, 2019 was a good year for the financial markets, and 2020 has been okay so far, I guess. So Chuck, tell us about what's going to happen the rest of this year.
I guess it's afternoon. Good afternoon. I appreciate everybody being here. I also appreciate being introduced by a former student. He's right about my last name. When I went to New York, somebody asked me whether I suggested that I go out and buy a vowel. I realized you can get everything in New York. There's got to be a vowel store on the Upper East Side. So I watched the debate last night. I watched a little bit of the ball game, watched the debate. During the day, the market was up. Stock market hit a record level. In fact, it had hit a record level several times last week. This morning, as of now, it's down 1%. Now, I'm not saying one thing caused another, but clearly there's a source of volatility here. From last year, so Bill went over some of his forecasts from last year and what happened. Let me mention here, last year, I had forecasted the market would be about below average return. I was spectacularly wrong. The returns were 19.4% from a year ago when I made this forecast. Average is about 7%. But wait, from February, from the time I made last year to October 25th, that's 173 days, I was right. So in fact, when I made that forecast, I had made it the previous November. So that means I was right for 244 days. It's just that sometime in the fall, late October, actually October 9th it started, the market started to go up and kept going up and added in the 79 days between October 25th, where I first became wrong, till now the market added $3.4 trillion. That's where most of the return came. So let's take a peek for a moment at those 79 days and see what happened. You may not remember that early in those beginning, or roughly around October 25th, the Fed cut interest rates. They cut the federal funds rate. And of course, if you also may remember there was an inverted term structure last year. That means the long-term rate was lower than the short-term rate. That happened from roughly about March till October 9th. That term structure shifted. Fed cut rates. That all became a positive for the stock market. Of course, that's just the market forecasting something good coming. The second was the second thing that really happened, I think, was the trade war start to settle, and really this market's been going up and down with the trade war and the battles between, especially with China. Although, as Bill pointed out, we are getting a new factor involved, and that's the coronavirus. At this point, the companies, the S&P companies who are reporting earnings, there have been about 138 who have reported earnings as of the first quarter of 2020. They are not changing their guidance as far as coronavirus, although it's the first thing they're asked about. Okay, so at this point, it hasn't affected. Roughly about 30 revenues for the S&P 500 are roughly about 38% outside the United States. So I mean, it's possible that and certainly it's enough of a factor so analysts are asking them. The election certainly will have an impact. I'm not sure. I mean, it's hard to predict, but frankly, after watching the debate, I mean, I think almost everybody, perhaps with the exception of Bloomberg, we're going to watch the market march down if Democrats are elected. But I don't know. I mean, it's plausible that it's certainly plausible that what happened this morning had something to do with the debate last night, although maybe not. The other thing that Bill, I want to focus a little bit more on the trade war because I think that has something to do with the market. Bill mentioned business investments down. and it's been flat for the not down, but flat for the for 2019. This is partly, I think, due to the instability in Washington on trade regulations. There was a study by Federal Reserve economists that looked at both waves of trade policy shock. First was in 2018, roughly late summer. Then the second was second half of 2019. By shock, they mean increased tariffs and disruption of normal relations. They argued that it took 1 percentage point off of GDP growth. National Association of Business Economists and their surveys report trade policy as a key economic risk through 2020. So I think that's, to me, it's as important as the coronavirus. And I think that's something that we need to look at. But having said that, let's look at some specific fundamentals. So some positives for fundamental. What I mean by fundamentals is I'm going to look at what drives earnings and what drives, so if you think very simply, I think of the factors that are lined up that drive earnings, and then earnings get valued into the price. Let's call that a PE ratio. So there's factors that drive up earnings and factors that change the PE ratio. Let's organize them that way. The positive earnings are that analysts are forecasting earnings will increase by 8% for the S&P 500. Now that's a little down in forecast from last year, but I mean that certainly is not that's certainly a source of growth. Energy is predicted to be 25%. Financial sector is expected to be the worst at 4.4%. Revenues are also expected to be up about 5.2%. So obviously people are expecting that the costs are cut. Best sector, communication services. Worst sector, financials again. The actual revenue growth was a positive 3% for 2020. IPOs are also fairly strong. I mean, that's always a good sign. You had the biggest sector was technology. Uber raised $8.1 billion. Slack raised $7.3. But of course, we had the disaster of WeWork, which was an exciting time. If you want to see how an IPO screws up, study that history. The negative fundamental factors, I have a little bit longer list. First, 2019 earnings were actually flat. They last year at this time, I think they were predicting about 8 or 9%. They were actually about zero. I think it was 0.03%. Those companies with more than 50% of their revenue outside the U.S. had actual earnings decline. So that's the impact of trade. 7.6%. Again, 38% of the S&P 500 has exposure overseas. But that's separate. That's not distributed equally. Information tech is about almost 60. Materials is actually greater than 50. And so those are the companies that are going to be affected by the and they're leading companies. Frankly, the Boeing situation that Bill talked about is a worldwide effect. There've been sectors that have shown a decline in earnings. Companies are guiding earnings down this first quarter. Okay, again, they're not doing it because of coronavirus. They're doing it because they think earnings are going to be falling. Falling from the growth is still positive, understand, but companies are guiding it down. The market is rewarding positive surprise less, although the great positive surprise in the first quarter was GM, which had it fooled the analysts by 300%. And the analysts were projecting a number, and they announced 300%. GM went up a lot. But the market generally is rewarding surprises less and punishing earnings falling more. Now, that's all on the earnings side. Let's take a look at the PE side. That is, you give earnings times PE, that gives you price, right? It tells me where we're going to go. Earnings PE, the PE ratios are high. Current PE ratio is 24. The historic average is about 15. I mean, that's a big number. And then what people also like is a forward PE. So take price today and earnings forecast, right? And that's high. That's 18.9. The history of that is about 16. And And then finally, some of you may follow the Shiller-Cape ratio. The Shiller-Cape ratio has predicted, arguably, many of the depressions and downturns over the past, I think he's been doing it since 1926. He hasn't been doing it. He goes back on the website since 1926. Schiller's an old guy, but not that old. That's at 31.9, and that's just one of the. I mean, that's something it's averaged about 16. This is something that is pretty close to where the dot-com crash. I mean, which was about 30 just before. So we are talking about nosebleed for valuation ratios. Now maybe earnings will go up, maybe that will fall. But having said that, there's little room for the valuation to grow. Stock repurchases over dividends. That's opting to repurchase shares is actually a negative sign, right? They're not companies aren't investing in them in itself, and that's going to grow to 2019 it was 710 billion. All this has led to volatility, and the VIX, if you follow it, has been volatile. Not so much as volatile, though, as 2018. 2018, it was pretty volatile. 2019, it was a little bit less, but still, it's a pretty volatile. And then, of course, we have the U.S. government. So we start off with budget deficits. We're going to $1 trillion. We're going to be pretty close to that in 2020. The deficit is about 4.5% of GDP. U.S. debt held in private hands is about $16 trillion. This ratio was it's about 78% of GDP, and that's growing. This Congressional Budget Office expects it to grow to 88%. There is not once in the discussion, in the 2-hour debate last night, did anybody mention the U.S. deficit. Not once did anybody mention the amount of debt. It's amazing on both the Democrat and the Republican side. No one seems to care about that number. Partly because it's not increasing interest rates. I mean, I think that's absolutely clear. I mean, Bill's forecast for the 10-year rate is what? 2.1, 2.8, something like 2.2, something like that, for the 10-year rate. I mean, this is remarkable. Of course, we've still got the funding deficit in Social Security, and then finally we come to international risk. Even before the coronavirus, the IMF forecast was saying that the pace of the global economy remains weak. Okay, momentum in manufacturing has weakened substantially to levels near 2008. Rising trade and I'm reading their forecast. Rising trade and geopolitical tensions cause increased uncertainty about the future, and that's before the coronavirus. The China economy had slowed to below 7%, and I'm sure it's going to be a lot less today. By the way, one company has been affected, and that's been Apple. Okay, Apple has moved its major manufacturing from Wuhan, which is the source of the coronavirus, to India, and they did it in like 2 days. And Apple has also said that China's got a third of their sales in the iPhone, and they're not sure they're going to be able to meet their sales targets there. So adding all this up, what does this mean? Well, I'm going to come again with a below average forecast, but still positive. Now, I hope I'm wrong again. I hope it's 19% again. That'd be great. But I just think the positives are only slightly outweigh the negatives, especially those valuation ratios are high. Earnings are relatively weak. They're positive, but they're weak. They're likely to stay weak until business confidence improves. Business confidence just has to go up for earnings to get better. And to me, that's related to federal policy in Washington. Clearly the White House has an incentive to stabilize it, right? I mean, this White House does not want negative numbers in the middle of an election year. But I still think, given the lags here, that we'll see a below average returns. I also think that this is, if you follow this, and I'm sorry if I'm getting a little wonky, that value stocks may be outperforming growth stocks. Companies that have low, good, solid cash flows, low debt. And I joke with my class, and I'm sure he's heard this joke, in really cold places, those are the kind of companies that Warren Buffett likes to. They're less affected by these factors. I think they're going to start to outperform growth stocks, and that's just a bet. We think that Treasury bonds will show a small increase, but the long term, sooner or later, right now the inflation is forecast to be low. So longer term, when people are putting money into bonds, which is happening a lot. My brother's a mutual fund bond manager. It's on the short end and medium term, not on the long end. So, what all this means for the state of Indiana, Ryan Brewer.
Good afternoon. So I have the pleasure of going after Chuck Trzynka, I think I said that name right, and Bill Whitty. So I'll start off. I heard Warren Buffett's name mentioned a minute ago, and there's something I like to say in my classes. This is about forecasting in general. It's better to be approximately right than precisely wrong. And when you're talking about forecasting, last night we did have the basketball game. I watched that instead of the debate myself. But I will promise you that I didn't get my data from Bloomberg, okay? But in November, we start doing this forecasting business back in about, September, October. We really start ramping up for our presentations in November. So this one's kind of late. So in November, I thought it was going to be pretty easy to forecast the success of the IU basketball team, the men's team. I thought, hey, they got Trace Jackson Davis, they've got Green coming back. They're going to be 20-0 at some point. And so that was wrong. So, this last season for forecasting the economy, and I worked on the Indiana state economy this year as well as the financial markets forecast. And I thought going into it, this was the hardest year based on the trade war, based on the uncertainty. We had an inverted yield curve. Chuck mentioned that a minute ago. So people were talking about the R word last fall, and people were getting scared. We were wondering what was going to happen. We had recession in manufacturing. So in Indiana in particular, we started to get concerned. So that's my preamble. Now, what I'm going to try to do for you is just ramble through some good information in hopefully some sort of a sensible fashion, but I can't promise you it's going to be sensible. It's just going to be a bunch of good information, not from Bloomberg. So we'll start with GDP. Last November, the forecast was below the nation at 1.25 to 1.5% GDP growth for 2020, where the nation was coming in around 2%. I think. And the reason for that was because at that time we'd had 3 successive contractions from the manufacturing index, which scared us here in Indiana. Because in Indiana, we are heavily reliant on manufacturing as a component of our GDP output. In fact, Indiana ranks first in terms of employment as well as output in the whole country with respect to the percentage of the whole GDP is a function of manufacturing. The third piece I'm going to talk about is employment. So we do have very low unemployment rates. The UE3 rate is the one that we see, and we're at historically low numbers there. We also want to talk about the labor force participation rate and what's going on with that. The fourth piece I'm going to talk about is wages and household earnings and how manufacturing and our reliance on manufacturing dovetails into that component. The fifth piece I'll talk about in a minute is venture capital investments and where Indiana fits in with respect to the rest of the country. And then I'll talk about risks, and we've heard some of them today with the coronavirus and Boeing and the trade war and that sort of thing. So I'll start diving in. I'm going to be flipping around through my pages. So Indiana, I'm expecting about a 2%, the same as the United States on GDP growth this year for 2020, because we have had some reasonably good news with the latest manufacturing index, which the survey came in slightly above 50%, which isn't great, but it's more expansive than contractive for the first time in several months, so that's good news. With respect to manufacturing, what I want to talk about there is Indiana. There's a tie-in with what we're doing in terms of readiness for the future. The economy's changing. We're moving toward a higher technological reliance, more intellectual property, more things that aren't manufacturing. When we get a downtick in labor force participation, when we have a recession in the country, Indiana feels it more severely. And I want to give you a case in point with that. West Virginia, they've relied on coal mining for a long time. And if we look at the numbers on West Virginia, which I'll get to in a minute, we'll see that they rank, and I don't mean to offend anybody from West Virginia. My mom's actually from West Virginia, so I feel like I can rip on my own state because, anyway, they rank near the bottom of the whole country with respect to a lot of numbers that we want to get better. And so that's what we're going to talk about here in a minute. So some of the risks that we have deal with the fact that our labor market may have gotten down to a really low point, and it might, as Bill said, go lower, but it's really hard to imagine it going lower than where it is right now. We have unemployment at, I think, 3.2% in Indiana, and in this county, the last reading was 2%. The lowest reading I could find in the United States was 2.5% in the country. That was back in 1953. So we're at 3.2% right now. The U.S. is at 3.5%. This county's at 2%. And the lowest it's ever been was back in 1998 at 1.3%. And in 1998, Indiana was at 3.1%. So it looks like that there's sort of a bowl shape that's happening. And the unemployment rate may be reaching a point where it's really hard to compress it further. I think it's sort of like, an analogy would be a basketball pump. We've been pumping the economy down kind of slowly and filling the basketball, filling the economy. But how much longer is the handle? How much more handle do we have to go until we run out of handle? So I see that as a risk. Again, the manufacturing index is slightly good, but for the next 6 months, I think Indiana is going to be okay. There are a variety of different states that we can look at to compare ourselves to, one of which is Minnesota. The ones that surround us, we can certainly compare ourselves to those. And what we'll see that there's a connection between wages and educational attainment rate. I did a study a couple of years ago about educational attainment rate, and it's a correlational study, so it's not causal. There's no shock there. It's just if you have higher educational attainment, wages tend to be higher. And importantly, during times of recession, the unemployment rate for those that have higher education tends to be more stubbornly low. And so Indiana really has an opportunity right now, perhaps right now but not next year, to get ready for this new transition as we go forward and we experience another recession, if that's going to happen, to get ready for that recession so that we don't experience poverty. So what I want to talk about now is the poverty rates in these states. So Maryland has a high educational attainment rate. Their poverty rate is 9%. Minnesota also, a higher educational attainment rate, 9.6. Ours is 13.1%. South Carolina, 15%. Kentucky, 17%. West Virginia is 18%. And these states have, obviously a lower higher educational attainment rate than we do. So I think, at the end of the day, we have some risks out there that we can't really put our minds around. The coronavirus and how it's going to impact what we do in Indiana. And I have some notes on there. I'm digging for it. I'm going to find it here. About how that would affect Indiana. And that, I think, gets to the fact that we rely on imports more than the rest of the country does. In 2019, Indiana imported $64.4 billion worth of goods out of a $370 billion economy. That's about 1.9% of the total U.S. GDP. So we import from Ireland about 10 billion, China 8 billion, Canada 8 billion, Japan 7 billion, Denmark 6 billion, Mexico 5 billion, the rest of Europe, not Ireland, 10 billion. And the exports were 39.4 billion in 2019, about 2.4% of all U.S. exports. So, Indiana's economy is 10.6% reliant on export markets with Canada, Mexico, Japan, China, and Europe. And we exported to 25 countries in 2019. So because we're a big manufacturing state, we export vehicles, transportation equipment. That's about 33% of what we export. Chemicals are 23% of what we export. Machines, not transportation vehicles, are 13% of what we export. And electrical devices are 8%. When you add all this up, Indiana relies on imports and exports disproportionately compared to the other states in our union. So if we do have problems with the trade war, or we do have problems with the coronavirus, or we do have problems with a recession, if it does come, and it doesn't even have to be a heavy recession like what we got in 2008, just a downtick, Indiana feels the pain disproportionately because our workers tend to be let go quicker than workers in other states. And interestingly, a lot of the states that we're talking about that have high wages and a more stubborn unemployment rate in times of recession tend to be blue. And I'm not really sure if they like capitalism or what's going on there, but that's just an anecdote. So with that, I will sit down and let you guys ask questions. Thank you.
So like we said earlier, today is going to be an opportunity to ask more questions. So we'll go ahead and get started. If anybody has a question, please raise your hand and we'll get to the panelists and let them answer it for you. Go ahead, Mike.
Ryan just talked that we get $10 billion from Ireland we import. Do we know what that is or have any idea where that comes from?
It's probably whiskey.
That was my thought.
We all probably use some Irish whiskey about right now. I actually have no idea. That's a great question. It's a good thing to look into.
I think the one thing that's involved there are things related to the pharmaceutical industry.
Oh, yeah. Yeah, that's it.
Things related to the pharmaceutical industry is one, and possibly some things related to electronics. The Irish have an economy that is geared toward producing for their export markets.
Anybody else?
So instead of whiskey, it's drugs.
I'm a little concerned about policy on workforce development. Maybe we made a reference to it, I think, about what's going to happen in terms of the education level of our workforce and whether we need to upgrade the general education or to specifically educate for jobs in the economy in Indiana.
This is literally a multi-billion-dollar question, and it's the answer is going to be an opinion, of course, and it's got to do with cultural change and cultural shift and receptiveness toward higher education. Right now, I think higher education is kind of on trial with respect to student loan debt and value that you get out of it. And us sitting up here, economics and finance are fairly popular majors. I think Chuck's talking it before the panel started. It's the most popular major in Bloomington. So we produce, if you talk about engineering, STEM majors, business majors, we can go out and immediately have an impact in society and add value. I think those are easier to sell, but some of the other, college is on trial right now, and I think that's part of the problem and the resistance. But the issue is, if Indiana doesn't come around the curve, much like Minnesota has, and I use Minnesota because it's another Midwestern state, not to the south, not to the west. It's got a little bit of lakeshore coastline, and it's not incredibly great to go there during the wintertime, but for some reason they have a higher level of educational attainment and they've got a better economy. Minneapolis is considered to be one of the most dynamic cities in the Midwest, and it's certainly usurped Indianapolis and perhaps Chicago in that regard. So that's a tough question, but if we can shift our culture, I think we can definitely get ourselves ready for the next downtick so we don't suffer as much in terms of poverty and unemployment.
Anybody else? Daryl?
Along that same line, with poverty and unemployment, as everything starts moving up, that line also moves up. But it seems like with all the support we give to people from, we'll use the generic term entitlements, that we have a cliff there, and then all of a sudden, you can't get to that next level because all the benefits you were getting went away. As you guys, as economists, is there some way to do something kind of like Social Security did with, for every $3 you earn, you lose $1 instead of just a cliff, and maybe that would aspire people to get to that next level so that they can contribute better?
That's certainly a problem. And, you know, economists say that the best answer is to replace a lot of the categorical welfare type programs that produce these cliffs with something like the earned income tax credit, which works as a negative income tax. But even that, the problem is that if you phase it out slowly so that you don't have points where people really run into the question, gee, you know, if I take this better job that pays 10% more, I'm only going to end up, because I'm losing some of my income tax credit, I'm only going to end up with 2% extra, and it's just not worth it. The problem is if you eliminate those kinds of problems, the phase out is so slow that the programs themselves then get enormously expensive. It's almost a catch-22 kind of thing. Certainly there are some proposals out there that would seem to me to make the problem much worse. One of the candidates that I think just recently dropped out was proposing a guaranteed income for everybody, $1,000 a month for everybody, no matter what they do. Well, that creates a $1,000 a month cliff. You know, unless you can find a job that pays more than $1,000 a month, you're not going to even consider working. And once you get in the habit of not working and learn how to live on $1,000 a month, you know, it perpetuates itself. So that's a bad idea. Things like debt forgiveness, you know, a lot of these programs have unintended side effects. You forgive student debts, nobody is going to pay for their own education, right? If you can just go out and borrow, and then you know sooner or later the government's going to just let you go, why should you pay your own money when you can do that? Free tuition, you know, it's a truism. You get what you pay for. If higher education is free, it's probably going to be worth what you're paying for it, or closer to what you're paying for it than it is now. I think that's been a problem. That's the problem now. People view the debt. They're not paying for it. They'll pay for it sometime later. And I think that shows up in the kind of education you get. So, you know, we have to be careful about trying to solve the problems, because sometimes solutions are worse than you started.
To a certain extent, economic growth helps these problems. I mean, one of the factors that perhaps we didn't mention was the growth in wage rates, which has been relatively small, relatively flat, but that's because the baby boomers are retiring, and really the growth rates, at least according to the Fed studies I've seen, there's been a lot of growth rate at the lower end. Low-paying jobs have paid more, and not just because of a minimum wage increase. We're just talking about them going up faster. So my sense is that the programs need to be linked with the change in wage rates.
Thank you. Go ahead.
Do you guys have any predictions on what the Fed might be doing for the remainder of 2020 and maybe the nationwide housing market for 2020?
I can tell you that my forecast is predicated on the Fed staying where they are with regard to interest rates. And can basically the status quo with regard to asset purchases as well, which they have restarted doing to a small extent. With regard to housing, I didn't mention it, but I probably should have. One of the things that was better in 2019 than for the couple previous years was housing. At the end of the year, in the last 2 quarters, housing was growing at about 5%. And that followed 2 years of negative growth where the housing sector actually shrank. And the numbers so far this year, we just got January numbers for housing starts and they were strong, and so were housing permits. I think, and my forecast has the housing sector much stronger than it had been in 2018 and than it was in the first part of 2019. That's sort of not a surprise. My model has been saying that housing was too weak for a long time. But why it changed now, I don't know. I could never quite figure out why it was so weak, although I thought that regulatory things and labor availability and things like that were part of the story. But none of those things seem to have changed to me very much. So maybe it's just that finally we got to the point where we just have to build more houses. We haven't been building enough houses for population growth that we have. So that's not unexpected that it's better, and it's nice news that it is.
Jim, you'll have the last question.
Thank you, Nick. You didn't make any mention of it, but in the fall of 2019, there was a crisis in the repo markets, and there was some liquidity issue there. I don't recall you saying much about it. But it seems like the Fed they said they're not doing quantitative easing, yet they are doing it. So what prompted that event?
One of our faculty used to be head of the research of the New York Fed, and he was running up and down the hall railing about how incompetent the current New York Fed open market operations are because of that repo problem. So the reason why I didn't mention it was I saw that as temporary, just a matter, and certainly there was a repo problem, but I saw that as temporary and not really affecting interest rates. I mean, eventually the New York Fed figured out what they were doing on that.
Laura, I'll turn it over to you.
Thank you, Nick. Well, I'd like to take one last moment to thank all of our sponsors. Our Bull sponsors are Eagle Crest, German American Bank, Hoosier Hills, Kimball Electronics, Merrill Lynch with Ken Sendewick, Old National Bank, Springs Valley Bank. Our Bear sponsors are Freedom Bank, Kimball International, OFS. Again, thank you for the Cool Springs shout out there. WBDC, WJTS, WITZ, WQKZ. And our neutral sponsors are Ed Cole and Du Bois Strong, Du Bois County Herald, Memorial Hospital, and Nante and Associates. One last reminder, Daryl, if you want to head on back to the drink station, you'll be able to get your CPE credit for the CPAs. Daryl?
Everybody, write legibly on your email, because that's how you're going to get your certificate.
Good point. Thank you. We got to be able to read it. If you guys have questions for Ryan or Chuck or Bill, they'll be around afterwards. Everybody have a prosperous afternoon.